Imagine running this massive billion-dollar manufacturing empire, right? And your home turf is absolutely booming.
Oh, yeah.
But like your international markets are just in an absolute free fall.
Total nosedive.
Exactly. You're generating mountains of cash, yet your profit margins are getting squeezed so hard that you have to completely slash your financial promises for the rest of the year.
Which is a tough spot to be in.
It really is. So today, we are looking at a company caught in exactly that tug of war. Welcome to our Talk Ticker style deep dive into the Q2 2026 earnings call of A.O. Smith Corporation.
Ticker symbol AOS.
Yeah, AOS. Our mission today is to take the raw, unfiltered data from this call, strip away all that, corporate spin, and figure out what the actual mechanics of this business mean for you, the retail investor.
And we are going to be very data forward here.
Oh, absolutely. We have the transcript right here. It features CEO Steve Schaefer, the outgoing CFO Chuck Lauber, and the incoming CFO Carrie Anderson. We are going straight into the belly of the beast to translate this Wall Street speak into actionable reality.
Yeah, and looking at this specific transcript, A.O. Smith provides one of the most fascinating case studies of the current economic moment.
It really does.
We are dissecting a legacy manufacturer here, a company that literally bends steel into water heaters and boilers, and they are colliding headfirst with massive macroeconomic headwinds.
Like a perfect storm of headwinds.
Exactly. You have intense raw material inflation, highly complex global supply chain dynamics, a distressed Chinese consumer market, and on top of all that, a shifting executive suite.
Right.
It is the perfect stress test for any analytical framework, really, because it forces us to look past the headline revenue and understand the underlying gears of the business.
I mean, I have my red pen ready because when you actually decode the language in these transcripts, the story is just packed with tension.
It is.
So, per our Talk Tickers format, let's start with section 1, the headline numbers.
Let's do it.
These are the big flashy numbers that hit the trading terminals first. Total sales for the second quarter hit approximately $1 billion.
A huge milestone.
Right. And adjusted earnings per share, or EPS, came in at $1.03. Now, on the surface, a cool billion-dollar quarter sounds like a massive victory lap.
It really does sound impressive.
If I'm an investor glancing at my phone, I see $1 billion and I just think, well, great, they're printing money. Everything is totally fine.
Yeah. Hitting that $1 billion threshold in a single quarter, that's a major psychological milestone. It signals immense scale.
Definitely.
You do not move $1 billion worth of water heaters in 3 months without a highly sophisticated logistics network and, really deep market penetration.
Right. You need serious infrastructure.
Exactly. But as you and I both know, the top line revenue figure is essentially just the cover of the book.
Oh, totally.
It tells you absolutely nothing about the cost required to generate that billion, the pricing power the company wields, or, and this is key here, where geographically that billion actually came from.
And with A.O. Smith right now, the origin of that revenue is where the structural integrity of the entire company is really being tested.
Yeah, it's pulling them in 2 different directions.
Okay, let's unpack this.
Yeah.
Because we are really looking at a tale of 2 entirely different corporate realities.
We really are.
When you break down that $1 billion, the geographical divergence is just staggering. North America was the absolute bright spot, just a massive engine keeping the ship moving.
Yeah, doing the heavy lifting.
Exactly. Sales in North America increased by 5%, hitting $821 million.
Which is solid.
It is. Now, the transcript specifies that this includes 3% organic growth, plus a $16 million boost from their recent acquisition of a company called Leonard Valve.
Right, we should clarify that for a second.
Yeah, for you, the listener, when management says organic growth, they just mean the growth of the business they already owned. They are excluding the extra revenue they essentially just bought by acquiring a new company.
So they didn't just stumble into that extra $16 million.
Exactly. Their base business grew 3%, and they bolted on another $16 million.
And that 3% organic growth, that is a critical metric to isolate. I mean, it might not sound like, a software company level of explosive growth.
It's not exactly a tech stock.
No, not at all. But you have to understand the context of the manufacturing environment right now. We are talking about an industry heavily tied to sluggish housing markets, elevated interest rates, and a really cautious consumer.
Yeah, the macro picture is rough.
So in that environment, scratching out 3% organic growth is incredibly hard-fought. Furthermore, that Leonard Valve acquisition is highly strategic.
How so?
Well, they didn't just buy revenue, right? They bought Specific commercial water management capabilities. Think highly engineered temperature control valves that are used in hospitals and large commercial buildings.
Oh, I see. So it's not just residential tanks.
Exactly.
Yeah.
It diversifies them away from just selling standard residential tanks. North America is the undisputed anchor for A.O. Smith right now.
But that anchor might be dragging on the bottom a bit, because we have to talk about the other side of the ledger.
Yeah, the international side.
And this is where the music completely stops. The rest of the world segment saw sales plunge 19% down to $195 million.
A massive drop.
It really is. And when you zoom in on China specifically, the numbers are frankly terrifying. Sales in China decreased a staggering 28% in local currency.
Wow.
Management explicitly pointed to a weak consumer appliance market over there. So I'm looking at this and thinking, like, how long can North America carry this?
It's a great question.
I mean, is this like having a star quarterback but a defensive line that just keeps giving away points? Can a company survive long term if almost a quarter of its global footprint is in a 28% free fall?
Well, you'd think a 28% regional drop would sink the whole ship.
Yeah.
But the data actually points to a much more complex reality when you look at how they are managing the North American profitability.
Okay, lay it out for me.
The international struggles are severe, yes. I mean, when a market drops 28%, it is not a blip. It is a structural contraction.
Right.
However, despite the revenue drag from China, A.O. Smith's operational discipline resulted in North American adjusted segment earnings of $200 million.
$200 million just from North America.
Exactly. That means on their home turf, they are still extracting a massive amount of cash. But, and this is a massive but, we have to look at the segment margin.
The margins.
Yeah. Despite the top line growth in North America, the segment margin actually dropped 100 basis points to 24.4%.
Okay, let me jump in and translate that for a second. For you, the listener, who might be tired of Wall Street jargon, 100 basis points is just a fancy way of saying 1%.
Correct.
So their profit margin in North America shrank from roughly 25.4% down to 24.4%.
Yes, exactly.
So my question to you is, if they are making $200 million in profit and the margin is still a very healthy 24.4%, why should we care about a tiny 1% drop? I mean, it feels like nitpicking.
It is the absolute opposite of nitpicking. It is the canary in the coal mine.
Really? Just 1%?
Yes. Margin is the ultimate undeniable indicator of a company's pricing power and their cost control. When your total sales volume goes up, but your margin percentage goes down, you are looking at margin compression.
So it's costing them more to make that money.
Precisely. It means the underlying raw materials, the labor, the freight, the literal cost of building the water heater is rising faster than A.O. Smith is able to raise the price tags for their consumers.
Okay.
Yes, 24.4% is a historically robust margin for heavy manufacturing, but that 1% drop is a warning light flashing on the dashboard.
Because it hints at a larger problem.
Exactly. It forces the critical question, is this a temporary one-quarter anomaly, or is this the beginning of a sustained trend where inflation fundamentally eats away at their profitability?
And that question leads us directly into section 2 of our deep dive. The story behind the numbers. The actual drivers and headwinds of this quarter.
Right, the mechanics of it.
Because it wasn't just water heaters that drove that North American growth.
Yeah.
I was reading through the Q&A portion of the transcript, and I was completely caught off guard by the boiler business.
Yeah, that was a standout.
It really was. The North America boiler business surged 21% in the second quarter. It's up 12% for the first half of the year.
Huge numbers.
Management credited strong commercial demand and something they called seasonal early buy programs. I just didn't realize boilers were a high-growth sector.
It is a remarkable data point, and it perfectly illustrates why sector diversification actually matters.
Right.
When most people hear A.O. Smith, they think of, the 50-gallon tank sitting in their residential basement.
Right, just a basic home water heater.
Exactly. But a massive portion of their business is commercial. Think of a 500-room hotel, a university dormitory, or a massive hospital complex.
Oh, wow. Yeah, those places use a ton of hot water.
Tons of it. Those facilities require highly engineered, massive-scale boiler systems to manage their hot water and heating infrastructure. A 21% surge in Q2 is explosive for heavy commercial equipment.
It really is.
But we have to apply our analytical lens to why this happened. Incoming CFO Carrie Anderson and outgoing CFO Chuck Lauber explicitly detailed the mechanics behind this surge.
Okay, what did they say?
It wasn't just organic economic growth. It was heavily driven by customer pre-buy activity ahead of announced price increases.
Okay, this is the part of the transcript that absolutely fascinated me. It's what I'm calling the pre-buy illusion. Let me map out how this actually worked for the listener.
Go for it.
So, A.O. Smith announced they were raising prices on their water heaters and boilers by roughly 4 to 7%. But they didn't implement the price hike on the day of the announcement.
Right, they held off.
They delayed the implementation by about a month. They explicitly stated this was to stay competitive with other players in the market who were also adjusting prices.
Which makes strategic sense.
Sure, but what actually happens? It's like a bar announcing that the price of a pint is going up by $2 at midnight. What do the patrons do?
They order 5 rounds.
Exactly. They rush the bar at 11:30 to buy as many drinks as they can physically hold. The wholesalers and distributors saw the 4 to 7% hike coming, and they rushed to place massive orders in Q2 to lock in the old, lower prices.
That is an excellent way to conceptualize it. It is a fundamental behavioral economic response at the wholesale level.
Just human nature, really.
Exactly.
Yeah.
If you are a distributor managing a massive warehouse and you know the cost of your primary inventory is going up by 7% next month, your fiduciary duty to your own business is to buy as much inventory as you can safely store right now.
Right, you're trying to save money.
You pull your future capital expenditures forward to capture that arbitrage.
But doesn't that just steal sales from tomorrow to pay for today? I mean, if I am a retail investor looking at this massive $1 billion quarter and getting all excited, isn't this entire 21% boiler surge just an accounting illusion?
It's a valid concern.
They aren't actually growing the pie, right? They're just aggressively moving sales numbers from the Q3 bucket into the Q2 bucket. Using my analogy, the bartender is going to be incredibly lonely at 12:15.
That is precisely the risk, and it is why reading the transcript is so crucial rather than just looking at the headline earnings beat.
You have to look under the hood.
Right. To management's credit, they were highly transparent about this dynamic on the call. They fully acknowledged that this pre-buy activity pulled expected third quarter demand forward.
Look, at least they admitted it.
Yeah. Now, I wouldn't call it an absolute illusion. I mean, the cash flow is real, the inventory actually moved off A.O. Smith's docks, and the revenue is formally booked.
The money is in the bank.
It is. But it is absolutely a forecasting illusion if you make the mistake of using Q2 as a run rate for the rest of the year.
A run rate. Let's define that.
For the listener, a run rate is when you take one quarter's performance and assume the company will replicate it for the next 3 quarters. You cannot extrapolate that 21% boiler growth into perpetuity.
Because it was a one-off event.
Exactly. A significant portion of it was a one-time artificial rush to beat the clock on inflation.
And speaking of inflation, we have to talk about why that profit margin compressed to 24.4% despite this massive surge in sales volume.
This is where it gets tough for them.
Because while the distributors were rushing the bar to buy cheap water heaters, A.O. Smith was getting absolutely hammered on the cost side. They were fighting what looks like a multi-front war on input costs.
The transcript outlines a severe convergence of inflationary pressures. The most dominant factor, without question, is steel. Yeah. At its core, a water heater is essentially a giant, highly pressurized steel cylinder. Management noted on the call that their steel costs jumped approximately 20% year over year in the second quarter.
20%. That is a catastrophic spike for a core raw material. I want the listener to really think about the mechanics of this.
It's huge.
If you are manufacturing a product that is 80% steel by weight, a 20% jump in the cost of that steel is going to instantly vaporize your profit margins, unless you can hike your consumer prices the very next day.
Which they didn't do.
Right. As we just discussed, they delayed their price hikes by a month to stay competitive. So they were essentially buying steel at a 20% premium, but selling the finished water heaters at the old lower prices to accommodate that pre-buy. Precisely.
You have identified the exact mechanical cause of the margin compression right there.
It's just simple math.
It is. In the manufacturing world, supply chain contracts for raw materials like steel are incredibly complex. Companies don't just buy steel on the open spot market every day.
Right, they have contracts.
They hedge, they use forward contracts, and they lock in pricing tiers. But eventually, the macro inflation catches up to the contract cycle, and that 20% spike hit their income statement forcefully in Q2. And the margin pressure didn't even stop at steel.
Right, because reading through the Q&A, the analysts were pressing them on other costs, and the list just kept growing.
It did. The transcript details two other major logistical and material pressures. First, transportation costs, specifically driven by diesel fuel surcharges.
Because they have to ship these things.
Exactly. Moving millions of heavy steel water heaters across the North American continent requires an immense amount of freight, and freight requires diesel.
Makes sense. What was the second pressure?
Second, they highlighted significant inflation in oil-based products. Consumers rarely think about this, but modern water heaters require highly specialized polyurethane foam for insulation between the inner tank and the outer shell.
Oh, to meet energy efficiency standards, right.
Exactly. Furthermore, various components and fittings are made of specialized plastics. Both the foam and the plastics are direct derivatives of petroleum, and those input costs surged alongside steel.
So you have the foundational metal, the chemical insulation, and the literal trucks required to move the product, all getting drastically more expensive at the exact same time.
A triple threat.
And if that wasn't enough, they are also navigating a shifting geopolitical trade landscape. The transcript specifically touched on the transition to Section 301 tariffs.
Yeah, that was mentioned briefly.
Now, listener, we are looking at this strictly from a balance sheet perspective, completely neutral in the politics of trade policy. The mechanics are what matter to the investor.
Just the numbers.
Management stated that the evolving Section 301 tariffs are causing a modestly higher cost impact on their supply chain. They did mention receiving some previous EPA refunds, but quantified it as a minimal benefit of about 1 cent per share. So the tariffs act as a slow, steady friction on their cost of goods sold.
Exactly. Tariffs basically function as a direct tax on the imported components within the supply chain. And for a global manufacturer, rerouting supply chains to avoid those tariffs takes years and significant capital expenditure.
It's not a quick fix.
No, not at all. Which brings us directly back to the most critical, existential, strategic issue facing the company right now, China.
The elephant in the room.
We mentioned the 28% revenue drop earlier, but the transcript reveals something much more profound than just a bad quarter. Management stated they have been conducting a formal strategic assessment of the China business for nearly a year.
A year-long assessment. I mean, when a corporation spends 12 months assessing a division, they aren't just figuring out how to run a better marketing campaign.
Well, no, they are looking at the foundation.
Right. They're looking at the foundational architecture of the business. Management made it crystal clear that all options are on the table. They're evaluating a complete spin-off of the division, entering into a joint venture or partnership, or fundamentally restructuring the internal operations.
Well, massive moves.
And they promised a final conclusion by the next earnings call. For the retail investor listening right now, this is a ticking clock.
What's fascinating here is the sheer scale of the decision they have to make. Operating as a U.S. premium brand manufacturer in China right now means navigating an incredibly hostile macroeconomic environment.
How bad is it over there?
Well, you have a profound real estate crisis in China, which depresses new home construction. And that directly kills demand for new appliance installations.
Right. No new house, no new water heater.
Furthermore, in a balance sheet recession where the Chinese consumer is highly cautious, premium brands suffer the most. A.O. Smith has historically positioned itself as a premium, high-tier brand in the Chinese market.
So they are the expensive option.
Yes. And when consumer spending contracts, you see massive trade-down behavior. Consumers abandon the premium foreign brand for a cheaper domestic alternative.
So what are the actual mechanics if they decide to pull the plug? Let's say they announce a spin-off on the next call.
A spin-off or a joint venture where a local Chinese partner takes majority control would instantaneously alter A.O. Smith's global financial profile. On the positive side, it would immediately excise that 28% revenue drag from their quarterly earnings.
It stops the bleeding.
It stops the bleeding. However, The mechanics of spinning off foreign assets involve massive regulatory hurdles, potential capital repatriation taxes, and most importantly, it means A.O. Smith would be forfeiting access to a massive demographic market.
Oh, right.
If the Chinese consumer appliance market rebounds in 3 years, A.O. Smith will have locked themselves out of that growth. It is a binary, irreversible strategic crossroads.
And this monumental decision is landing squarely on the desk of a brand new CFO. Chuck Lauber, the veteran outgoing CFO, spent the call handling the historical context, the pre-buys, the steel contracts, the margin pressure.
He was managing the rearview mirror.
Exactly. But it was Carrie Anderson stepping into the role who had to deliver the forward-looking outlook. And I have to say, her first major act as CFO was brutal. She had to slash the full-year guidance.
It is literally the hardest job in corporate finance when your inaugural act is lowering expectations.
I can imagine.
But as an analyst, you respect it because it reflects the raw data rather than wishful thinking. If their profit margins are already getting squeezed by 20% steel inflation today, it completely changes how we have to look at management's promises for tomorrow.
So let's transition into section 3 of our deep dive. Management guidance. Let's look at what they actually forecasted.
It wasn't pretty.
The previous guidance modeled potential sales growth for the year up to 4%. They completely walked that back, narrowing and lowering the expectation to a mere 2 to 3% growth.
A significant cut.
Even more painfully, the adjusted EPS, which they had previously projected could touch the $4 mark, was guided down to a range of $3.70 to $3.85.
So they are lowering both top and bottom lines.
Yeah, they are telling Wall Street, hey, we are going to sell less than we thought, and we are going to make less profit on what we do sell.
And this is where we have to connect the isolated corporate data to the broader U.S. economy. Why did Carrie Anderson have to slash those numbers?
Right. What's the actual driver?
The transcript provides a very specific mechanism, U.S. residential water heater industry demand. Management revised their industry outlook, stating they now expect total residential demand to be down in the low single digits for the entire year.
Which on its face seems counterintuitive. Water heaters aren't luxury items, right? They're basic utilities. People need hot water. Why would total industry demand shrink?
If we connect this to the bigger picture, it is all driven by the real estate ripple effect. A.O. Smith detailed 2 distinct macroeconomic weaknesses.
Okay, let's hear them.
First, softness in new construction. When elevated interest rates make mortgages unaffordable, builders stop building new subdivisions. If a house isn't built, a water heater isn't installed.
Right, that's a direct one-to-one correlation.
That is a direct, undeniable hit to the wholesale channel. But the second factor, sluggish existing home sales, reveals an even more fascinating psychological dynamic within the consumer market.
Yes. The transcript broke down the replacement market in a way that I think is the single most valuable insight of this entire deep dive. I'm calling it the flooded basement metric.
I like that name.
Management explained that 70% of all replacement demand is purely emergency driven. Let's walk through the mechanics of that.
Okay.
You go down to your basement on a Tuesday morning, there's an inch of water on the floor, your water heater has ruptured, and you have 0 hot water.
Total nightmare scenario.
Exactly. In that moment, you are not logging onto the internet to comparison shop for 3 weeks. You are not worried about the Federal Reserve's interest rate policy. You are calling a plumber, and you are buying whatever unit the plumber happens to have strapped into the back of their van.
Exactly. That 70% is incredibly resilient. It is highly inelastic demand.
Because you have no choice.
Regardless of inflation, recessionary fears, or consumer sentiment, if the tank bursts, the consumer spends the money. It creates a massive structural floor for A.O. Smith's revenue.
So they can always count on the emergencies.
Right. But the guidance downgrade wasn't caused by that 70%. The guidance was slashed because of the other 30%.
The proactive replacement market?
Correct. 30% of the residential replacement market is proactive. This represents the homeowner who knows their water heater is 13 years old, sees some rust forming on the bottom, hears some strange knocking sounds, and decides to replace it before it violently ruptures.
The planner.
Yes. Or it is the homeowner who is already doing a massive $50,000 basement renovation and decides to proactively upgrade to a high-efficiency tankless system or a heat pump model. That 30% is highly discretionary. It behaves much more like consumer electronics or luxury goods.
And right now, that proactive consumer is paralyzed. We look at the macro environment. Groceries are expensive, credit card debt is high, inflation is sticky.
They are feeling the squeeze.
So that homeowner looks at their rusty water heater and says, you know what? It's still making hot water today. Let's roll the dice and see if we can get one more year out of it.
They just delay it.
They delay the $1,500 capital expenditure. And when 30% of your market decides to collectively delay their purchases, your entire industry demand shrinks.
That is the exact mechanism driving the guidance cut. It is a fascinating psychological shift in consumer spending behavior, rippling all the way up to $1 billion manufacturer's bottom line.
It's all connected.
And this delayed consumer behavior, combined with the pre-buy we discussed earlier, leads us to the most severe explicit warning in the entire earnings call.
Oh, this is the part we need to highlight.
Here's where it gets really interesting. Management basically told Wall Street that the upcoming third quarter is going to look terrible. We can call it the Q3 hangover.
Q3 hangover. I want to spend some time here because retail investors frequently get blindsided by this exact scenario. Let's look at the recipe for Q3 that management laid out.
Okay, let's mix the ingredients.
First ingredient, the pre-buy hangover. All those wholesale distributors who played the bartender analogy and bought massive amounts of inventory in Q2 to beat the price hike, their warehouses are now stuffed to the rafters.
They physically have no room.
They physically do not have the space or the capital to buy more water heaters in Q3. So A.O. Smith's sales volume is mathematically guaranteed to drop as the distributors slowly burn through that Q2 inventory.
That is the volume contraction. Now let's look at the pricing realization. The second ingredient of the hangover is the delayed impact of the price hikes.
Right, because they held off on raising prices.
They raised prices 4 to 7%. But because they delayed the implementation and because the distributors pre-bought so heavily at the old prices, A.O. Smith won't actually see the financial benefit of those higher prices flowing into their income statement until the very end of the third quarter, or realistically, the fourth quarter.
So sales volume is down.
Yeah.
And the price hike isn't helping yet. And then we add the final, most toxic ingredient, peak inflation. Management explicitly warned that the highest steel costs of the entire year will hit their balance sheet in the second half, with a concentrated impact in Q3.
A brutal combination.
So, to summarize the mechanics of the Q3 hangover for the listener, you have plummeted sales volume. Because everyone already bought, you are not getting the benefit of your new higher prices yet, and the raw steel costs required to build the units are at their absolute apex.
When you combine those three distinct forces, the mathematical result is just inevitable. Management forecasted that Q3 earnings per share will be lower than both Q2 and Q4.
Wow, lower than both.
Q3 is a scheduled, structurally guaranteed earnings trough for the year. And the reason we are analyzing this so deeply is to prepare the listener.
Because the headlines will be scary.
Oh, when those Q3 numbers are eventually published, the financial news headlines will likely be terrifying. You will see algorithms triggering sell-offs based on the massive sequential drop in earnings.
But because we are decoding the mechanics today, the listener knows exactly why it is dropping. It isn't a fundamental collapse of A.O. Smith's ability to manufacture products.
Not at all.
It is a highly predictable timing mismatch between inventory cycles, delayed pricing power, and raw material contracts.
Exactly. Understanding causality protects you from panic selling. And to further assuage that panic, we have to look at the massive silver lining buried in this transcript.
Let's talk about the good news.
Amidst the guidance cuts, the steel inflation, and the Q3 warnings, A.O. Smith revealed an incredibly powerful financial metric, their free cash flow. In the first half of the year, free cash flow surged 67%, reaching $233 million.
Let's define that for a moment. Free cash flow is the actual cash left over after a company pays all its operating expenses and capital expenditures, like maintaining factories and buying equipment.
It is the true lifeblood of the company.
It's the money they can actually use to reward shareholders or grow the business. To generate $233 million in cold, hard cash in just 6 months, especially while fighting 20% steel inflation, is staggering. How are they physically doing that?
It is a masterclass in working capital management. A mature, deeply experienced manufacturer like A.O. Smith doesn't just manage the factory floor. They aggressively manage the balance sheet.
What does that mean in practice?
They pull levers on inventory management, making sure they aren't holding too much raw material. They optimize their accounts receivable, forcing customers to pay them faster.
Right.
And they stretch their accounts payable, delaying payments to their own suppliers for as long as contractually possible. By tightening those three gears, they squeeze massive amounts of cash out of the operational cycle.
Very smart.
But this immense cash generation raises the most critical capital allocation question for management. What are you going to do with $250 million?
And they didn't hesitate to answer that. They aren't hoarding it in a vault. Management announced they are increasing their 2026 share repurchase target by a massive 50%.
A huge increase.
They are bumping it up from $200 million to $300 million. They are taking that free cash flow, going into the open market, and aggressively buying back their own stock.
This is where retail investors need to think critically about the mechanics of corporate finance. Let's define what this means. A share buyback is when a company uses its cash to buy its own shares and essentially tear them up, retiring them from the open market.
It takes shares out of circulation.
Exactly. It shrinks the total number of shares in existence. So if the company's total profit remains the exact same, but there are fewer shares dividing up that profit, the earnings per share, the EPS, automatically goes up.
It artificially boosts the value.
It is what Wall Street calls an accretive move. It directly adds value to the remaining shares.
So on one hand, I look at a $300 million buyback, and I see the ultimate signal of executive confidence.
Management is betting on themselves.
Right. Management is looking at their own balance sheet, looking at the macroeconomic headwinds, looking at their stock price, and declaring, the market is wrong. Our stock is too cheap. The absolute best investment we can make right now with a guaranteed return is betting on ourselves.
It is a strong statement.
It creates a mechanical floor under the stock price because you have a guaranteed buyer with $300 million ready to step in.
That is the bullish interpretation, and it is mathematically sound. But we have to debate the bearish counterargument here. What does a massive buyback say about their growth prospects?
Right.
If a company is fiercely competing for the future, shouldn't they be deploying that $233 million to acquire new disruptive technologies? Shouldn't they be buying a competitor in Europe or expanding their commercial boiler footprint in South America?
So buying their own stock means they have no better ideas.
Does dedicating $300 million to retiring stock imply that management looked around the entire global M&A landscape and decided there was absolutely nothing worth buying? Is it a white flag on innovation?
I'm so glad you brought that up because it is a vital question. A buyback is essentially saying, we can't find a better use for this money.
Right.
Now, to be fair to A.O. Smith, they did just deploy capital to buy Leonard Valve, which added that $16 million to the top line. And historically, they have spent the last decade acquiring water treatment companies like Aquasana to diversify their portfolio.
True. They have a history of acquisitions.
But in a high interest rate environment, where the valuations of potential acquisition targets might still be absurdly high, sometimes the safest, most disciplined move is to simply shrink the share count and consolidate your power.
Especially if they expect a housing rebound.
Exactly. Especially if you foresee a massive housing rebound in 2027 that the broader market hasn't priced in yet.
It is a debate over capital efficiency versus aggressive growth. And right now, A.O. Smith is clearly choosing defensive efficiency. They are fortifying the castle rather than trying to conquer a new territory.
Okay, so we have dissected the revenue divergence, the mechanics of the Leonard Valve acquisition, the pre-buy bartender analogy, the triple threat of inflation and steel contracts, the ticking clock of the China strategic review, the flooded basement metric driving the guidance cuts, the mechanics of the Q3 hangover, and the psychology behind the $300 million buyback.
We covered a lot of ground.
Now it is time to synthesize all of this raw data into reality for the listener. Let's move to section 4, our talk tickers, actionable bottom line. So what does this all mean for you, the retail investor who is managing their own portfolio?
Time to take a stance.
Based on the intense multi-layered data we just tore through, I am taking a firm, opinionated stance. I am officially rating A.O. Smith Corp as a cautious hold. I see intense, mechanically guaranteed bearish signals in the short term, but a very strong, highly defensive bullish floor for the long term.
I completely agree with that structural assessment. Let's break down the logic of both sides, starting with the short-term bearish reality. Why must an investor exercise extreme caution over the next 3 to 6 months?
Well, if you're a short-term trader, a swing trader, or someone looking to make a quick entry based on a dip, this is an incredibly dangerous stock to touch right now. The math is simple, and management has practically telegraphed the pain.
Q3 is going to hurt.
Q3 is going to be exceptionally ugly on paper. We mapped out the Q3 hangover explicitly. You have the pre-buy pulling massive sales volume out of the quarter.
Right.
You have the peak 20% steel inflation hitting the income statement at the exact wrong time. You have delayed price realization. And looming over all of this like a dark cloud, you have a Chinese division that is down 28%, bleeding cash, with a massive strategic review hanging in the balance.
A lot of negative catalysts.
The next earnings print will likely trigger algorithmic selling. If you buy today hoping for a quick pop, you're walking directly into a scheduled buzzsaw.
That is the tactical short-term reality. The next quarter is mathematically compromised. But if we connect this to the bigger picture, the long-term bullish case for the patient, fundamentally driven investor is incredibly robust.
What's the bull case?
You are analyzing a company that operates in a market where 80 to 85% of total industry demand is strictly replacement driven. We spent a lot of time on the flooded basement metric, that 70% emergency replacement rate.
Right, the inelastic demand.
That creates a revenue floor that high-flying tech companies or consumer discretionary brands can only dream of. A water heater is not an iPhone. You do not delay buying it when it breaks.
When the tank ruptures, it must be replaced within 48 hours.
A.O. Smith is the dominant, entrenched player, perfectly positioned to capture that inevitable inelastic demand across North America.
And here is the crucial part of the long-term thesis. While you wait for the macro environment to improve, you are getting paid to wait. While you wait for the Federal Reserve to cut rates, for new housing construction to rebound, and for consumer confidence to finally unlock that proactive 30% replacement market, they are paying you. A.O. Smith is a cash-generating machine.
$233 million in 6 months.
They are paying a highly reliable quarterly dividend of 36 cents per share. And most importantly, they are aggressively stepping into the open market to buy back $300 million of their own stock.
Right. They act as a buyer of last resort.
Exactly. They act as a buyer of last resort to support the share price. That combination creates a massive structural safety net under your investment.
So let's crystallize the actionable advice for the listener. If you currently own AOS stock in your long-term portfolio, hold tight. Collect your 36-cent dividend.
Do not panic sell.
Above all else, do not panic and sell when the Q3 numbers eventually dip. You know exactly why they're dipping. It is a mechanical expected result of the Q2 pre-buy and the steel contract cycle. It is an accounting timing issue, not a broken business model. You ride out the storm.
But if you do not own the stock and you are sitting on cash looking for an entry point, patience is your absolute best strategy. Wait until the next earnings call is published.
And why is that?
Because of the China strategic assessment. That is the binary catalyst event you must watch. Until management definitively announces whether they are spinning off the Chinese division, entering a joint venture, or trying to restructure, that massive uncertainty acts as a heavy anchor on the stock price.
The market hates uncertainty.
The stock has a fundamental ceiling until that anchor is lifted and Wall Street can price in the new reality. Let the Q3 hangover pass, let the China decision be officially announced, let the algorithmic traders overreact, and look for an entry point when the dust settles and the long-term fundamentals take over again.
That is a highly disciplined, institutional-grade approach. It removes the emotion from the trade, respects the mechanical timeline that management has explicitly laid out, and positions you to capture the long-term floor while completely avoiding the short-term buzzsaw.
All right, before we wrap up this deep dive, I want to leave you with one final provocative thought to mull over. It is something we caught briefly in the Q&A portion of the transcript.
Oh, this was an interesting tidbit.
It wasn't heavily focused on in the main presentation, but it is an underlying structural shift that could define the next decade for this company. The Wall Street analyst asked about technology investments, and management briefly mentioned deploying AI tools for internal order management, warranty processing, and technical service routing.
Right now, it is strictly an internal efficiency play.
Exactly. It's a cost-saving measure, using generative AI to route replacement parts faster or handle basic plumber customer service calls to reduce call center headcount.
All right, that's what it is today.
But let's extrapolate for a second. Think about the evolution of your own house over the last 5 years. We are moving rapidly toward entirely integrated digital smart home ecosystem.
Everything is connected.
Your thermostat talks to your phone to learn your schedule. Your fridge can order groceries. Your solar panels optimize their battery storage based on the local weather forecast. How long until the humble, massive steel water heater becomes a primary smart tech hub in your basement?
It's coming sooner than people think.
Imagine a unit equipped with predictive AI that learns exactly when your family showers, optimizing its energy draw down to the minute to capture off-peak utility rates. Or a unit with microsensors that detects a pressure anomaly and automatically shuts down the house's main water line an hour before a catastrophic basement flood can occur.
The foundational technology is already emerging. Look at the transition to heat pump water heaters. They are no longer just dumb steel tanks with a gas burner.
Right, they're basically HVAC units.
Exactly. They are complex HVAC units relying on thermodynamics and refrigerants. They require highly sophisticated microprocessors and software just to run efficiently.
And here is the profound question for you, the investor, to keep an eye on as this industry evolves. Is a legacy hardware manufacturer like A.O. Smith, a company that has spent a century perfecting the art of bending steel and welding tanks, actually positioned to capture that massive technology premium?
Or will they get boxed out?
Are they at extreme risk of being commoditized by a Silicon Valley giant? Will Apple, Google, or Amazon decide they want total dominance over the smart home utility hub and just relegate A.O. Smith to being the low-margin metal bender who makes the dumb physical tank, while the tech company captures all the high-margin recurring software subscription revenue?
It is the classic hardware versus software battle.
And it's going to play out right there in your utility closet.
It is a phenomenal existential question. Ultimately, it pits two different types of loyalty against each other. Does the entrenched brand loyalty of the local plumber who has installed A.O. Smith for 30 years outweigh the frictionless software ecosystem that the consumer already lives in every day? We will be watching their R&D spent very closely in the coming years to see how they innovate beyond just the steel.
That is going to do it for today's analysis. We started with a simple $1 billion headline and dug all the way down into the mechanics of wholesale pre-buys, the thermodynamics of margin compression, the flooded basement replacement metric, the ticking clock in China, and the Q3 hangover.
He was a deep one.
Remember, never just read the headline numbers. Look for the structural mechanics behind the data, navigate the murky waters of corporate guidance, and always know exactly what you own. Keep learning, keep digging, and we will catch you on the next deep dive.